Welcome to OK Computer. I am Dan Nathan. I am joined in the studio with Deirdre Bosa, CNBC's Tech Check host, and I got co-host here on OK Computer. How you doing?
Well, I love being here and in person.
It's pretty better. Cool, right? Yep. So in the Big Apple, it's a big week here. We are going to preview all of the major tech earnings with Deepwater Asset Management's Gene Munster, your friend and mine. He's been doing this every quarter with us, I think for over a year now, doing a bit of a preview. So we're going to hit Microsoft, we're going to hit Google, we're going to hit Amazon, we're going to hit Meta, and then we're going to finish it off with Apple, which it reports next week. It's interesting. You and I, Dee, were talking about the biggest theme that we want to kind of take out of Q1 earnings season is really the hyperscalers. It's what these companies have to say about the pace of deceleration, where they're seeing it, maybe geographic, that sort of thing. Talk to me a little bit how you're thinking about, like, what do you think will be the most important takes? Is it going to be small and medium businesses? Is it going to be who knows? Like, what are you most focused on?
I think margins are going to be the big story, not necessarily the fact that they have come down for each of these sort of big tech companies, but how they're looking at them going forward, the amount of cost cutting that's left. And we've talked about this before. It's not growth at all costs anymore. For Elon Musk, it is still growth at all costs, but he's sort of the outlier. We compared this on Tech Check a few days ago, but the idea that Tesla's an outlier can say that they're going to focus still on growth at the expense of profitability, but I don't think that any of the other mega caps get that kind of pass. We saw that with Meta, how well it's done just this year in general.
They didn't get the pass. I mean, in the market, the stock was down 10%, right? And I think as some people kind of digested it a little bit more, they're basically saying, hey, listen, your automotive margins look like that of Ford and GM right now, and you trade at like a 10x multiple or something like that. And you know what's funny? And Gene and I get into Tesla, and we don't have to spend a lot of time on it, but I just wanted to make the point that market participants seem very focused on that. So to your point, are there companies that trade at cheaper valuations if they were to kind of give some of the same sort of commentary as it relates to the macro is pressuring margins, all that sort of stuff? I don't know. I think if the valuations are better, they might get a pass because a lot of the inflationary readings that might have been pressuring margins, they've abated a good deal.
Right.
Right?
But are we heading into a tougher second half? Yeah. And I think that's these tech companies now, the mega caps, have become the safety plays, the fortresses. So why are investors buying them? There's a lot at stake, right? Because we haven't seen tech this concentrated in a while. So if you see a Microsoft or if you see even a Google stumble badly, that's going to have ramifications for the broader market.
It's interesting. So Gene mentioned this, that in November, Apple gave kind of a soft pre-announcement for the calendar Q4 at the time. And I remember it. They didn't quantify it, which he mentioned. And then so when the company reported in late January, it was a miss. They missed the pre-announcement, at least what people were kind of thinking of in a way. And so it's funny when you think about, like, are they going to stumble, any of these big companies? It's like sometimes like the writing's on the wall a little bit. So we saw that that data from IDC on PCs. You know what I mean? You could easily extrapolate through Microsoft and the like here. So I guess I wonder is, like, in a day or two, are we going to be looking back and being like, oh, that was kind of obvious, if there are any big misses, I guess.
Yeah. It's also this weirdly paradoxical earnings season, right? Where there's so much excitement over further away growth products and growth shifts, platform shifts, right, with ChatGPT and generative AI. So investors are going to want that kind of innovation. They're going to want to know that Google is keeping up or taking back the lead from Microsoft. So they have to show both things, that they're being efficient, but they're also innovating still.
Yeah. Gene pointed to there's going to be a user conference for Alphabet on May 10th. So that's something that I think, in a way, if you think about the excitement that was around NVIDIA when they had that event. So, like, those are probably more important events for investors to get, like, a longer term time horizon, because on these calls, like going back to NVIDIA from a month ago, they said AI like 100 times on that call. And they said what they needed to say, and the stock has clearly been what a lot of investors think is maybe like one of the easiest ways to play this. Microsoft's such a big business; it's kind of hard to do that. And so, I guess at those sorts of events, it's kind of easier to see the roadmap for these products.
We'll see a lot of those events, at least in the generative AI, because this is the first sort of product that consumers can get their hands on. Satya Nadella did such a good job in hyping it up and being so outgoing. Can Sundar Pichai do the same thing? It's just not in his DNA. So what is I/O? That's the event on May 10th. We were there last year. And it was funny because we had the interview with Sundar, but they were talking about AI and the market wasn't ready for it. They couldn't digest it. But what's the saying? If you're too early, it's as bad as being too late.
Yeah.
So.
Well, didn't your hockey coach used to say early is on time a little bit? That doesn't work.
Doesn't work here.
It's funny in the markets, and again, is early is a tough place to be on a theme, because sometimes it makes you really challenge if you get in. And listen, this is what I wonder for a lot of these names is that there's so many. Look at the way we had crypto and Web3, and like all of these thematic things that a lot of big companies kind of push right into, and companies like NVIDIA have been at the forefront of all of it. They have been able to craft their narrative around Bitcoin mining and gaming and like the metaverse, and the list goes on and on and on. And that stock is trading really well. I think you were, I think that all of us would be. I think we'll look back and say it's going to be hard for them to grow into this valuation considering how much hype is built into it.
I was going to ask you about that, actually. You still think they're overvalued?
I think it's really hard. I mean, listen, I'm short it, and it's more like of a trade, if anything like that. But it just seems like, on every little pullback we get, I mean, people come in and buy it. But that's also the true of the NASDAQ right now. And, it's interesting when you think about just kind of where the NASDAQ 100 is at 13,000. It's literally been flatlining here for about a month, for most of April. And you and I talked about this last month. I guess it's not that surprising that so much money rotated out of like financialized sort of things into mega cap tech, but it really feels like something's about to give right here because of this like tight concentration, and then all of the enthusiasm about some of these hypey sort of things, and then at a time where valuations look a little hefty, and we are about to see the Fed funds rate go to 5% for the first time in a very long time, and that should also be something that weighs on valuations.
For maybe the smaller tech companies, yeah. But I guess the whole premise is you look at how much these companies are growing. You think tech, you think you're buying it for the growth. Apple's supposed to contract in terms of its sales this quarter. Amazon is the best of the bunch at 7%, but it's not really anything to write home about, right? So maybe you're looking for some other companies. I think Adobe was a late reporter last season, had somewhere in the teens, and the market thought, wow, that's great, because that's hard to achieve these days.
I think it's really interesting. And you and I have talked about this, and you spent a lot of time in Asia, reporting there from, like you were always our go-to. I remember that's when I think a lot of our listeners have heard me say this before. I mean, was it 15, 16? And remember there was like a big growth scare in China at the time, and you were coming on fast money. So you were 12, 13 hours ahead, that sort of thing. And, it's interesting. I feel like you have a great read on this because it's not just like the American, like being through the lens of the U.S. media, you were there on the ground. You had a lot of contacts there, that sort of thing. So when you see the sort of announcements that we've had going back and forth between our ban of advanced chips for a whole host of reasons, we get it, like, national security reasons, but also, if you think about supply chains, how important they have become since COVID as a means of national security too. Now you see the Chinese kind of biting back a little bit with some of our companies. How do you expect that to play out? Micron in particular is the one in the news today, and we can go to some of our allies. It's kind of, I guess, the report. This was at least in the FT today, saying that the U.S. is going to the South Koreans and saying, "Hey, listen, hold pat on some of these. Don't sell to the Chinese." How is this going to play out for us? Is it going to just keep getting ratcheted up?
Is it going to keep ratcheting up, or is it just sort of tit for tat and does none of it actually really matter, right? Because for the most important chips, the advanced ones, we know, and the Journal and others have reported that the Chinese government can set up these entities offshore and just buy those chips somehow. They can do it in very convoluted ways if they need it. And
we're seeing that with energy, with the restrictions about Russian oil and the like.
Exactly. And if it's hugely important, they'll find a way around it. So this is very calculated, you would think. The Chinese are very calculated. And remember, President Xi Jinping, it's part of his plan is to compete with the U.S. in terms of that chip design and manufacturing capability. He's nowhere near it now, but I think sometimes when they do these things, it's for their own population too, to say, look, we can fight back, we can push back. But again, very, very calculated where they can. These are chips that they must have taken stock of their inventory and stockpiles and see how much they have. They probably have an idea of where they can get them, if not South Korea, another entity that they've set up. But it's interesting because you see these headlines, for example, Alibaba and Tencent developing their own chips, Huawei even, which is even more worrying because the connection to the Chinese government is more straightforward or more more obvious with a Huawei. So we don't really know how far they've come. They're far from making advanced chips, but probably the lower level they're getting quite good at.
So let me ask you this, and this is not on our rundown here, but I feel like you have something to say. So Chamath Palihapitiya on his All In podcast on Friday said crypto is dead in America. And I think this is really interesting because I know you know a lot of crypto folks. I know a lot of crypto folks. And, some of those early crackdowns on mining, started in China. That's one really. And then you saw a lot of those operations move to other places in Asia. We know that there was crackdowns for capital flight, a whole host of reasons, but it's interesting that here in the U.S., you would think that someplace that's been really honed, like a great home for 50 years to technological innovation, and we haven't always been at the forefront of regulation. And I think that's one of the big criticisms. I think that's one of the reasons Chamath is saying this. But it's interesting because this is a day, it's Monday into the close here. Coinbase is down 7-8% or something like that. It really feels like this is not a great place to be if you are into crypto in general, other than owning it. And I'm just curious, thoughts on that, especially also with your experience being in Asia, because if China and the rest of Asia seem to crack down really quickly, this was going back a few years ago. Now it seems like the place to be in America is not, which is very odd to me.
It feels like that list keeps getting shorter and shorter for people in crypto, friendly places. And at the height of the boom, you heard a lot of people saying, okay, exactly what you're sort of saying. We're supposed to be leading innovation at the edge of technology and so on. So why wouldn't we let crypto at least develop under proper regulations? But I can't think of one lasting use case that came out of the last few years of crypto making something better. So there's not a lot to lose, right? At least for the regulators. And I still think that crypto and the technology behind Bitcoin is hugely useful, and we should be better at moving money now. Some really simple, basic things. That hasn't happened because it proves too complicated and there's too many bad actors that can get involved. So
it's funny, but here in the U.S., it's like I see the promise of that in relatively unbanked places, to us, and I don't really see it here. You know what I mean? I don't right now. I don't see a great use case for it. I've always kind of been in that camp. I've found the cult around Bitcoin in particular very odd, but I've seen the ETH and that blockchain. I find Ethereum really interesting. I think the idea of smart contracts is really interesting. I heard tons of really smart Web3 ideas that I think sounded really cool, and they disintermediate, all these middle layers that have been extracting a lot of value. I get all of that. I just still don't get the whole money moving around thing.
Okay, so I don't want to sound flippant because I can access my money. A lot of people can't, but in America, because I'm Canadian and my husband is Canadian, we actually are underbanked. Yeah. When I got here about 6-7 years ago, I couldn't open a credit card. I couldn't even open a bank account, and I didn't have any credit. Only recently have I been building credit, and every time I want to move money from Canada to the U.S., it is a hugely painful, expensive process. So I have seen this use case. It's crystal clear to me. I'm so disappointed that nothing has changed. To me, that's kind of what's amazing to me, is that there hasn't been a better process. You have so many smart people working on it, not just in crypto, but that's what they're trying to solve at PayPal and Square and a lot of the other fintech companies. They're trying to make it more simple. And obviously, the proposition has changed a lot. At a zero interest rate environment, you have money to try and solve these problems. But when rates are rising and their cost of capital is higher, it's harder for them to do so. And it's also become a little bit commoditized, right? The big banks are learning how to do this stuff.
Isn't it interesting? I'm glad you brought that up about Square. I feel like when Jack Dorsey was the CEO of Square and Twitter, he was a lot more vocal about Bitcoin. Remember in his Twitter profile, all he had was the Bitcoin cash tag. And, he's been, at the time, he was very vocal.
Well, he changed the name of the company to Block.
He changed it to Block. And I feel like we don't hear from Jack Dorsey anymore. And you know what's also interesting about the stock? It is unchanged on the year, which is truly fascinating when you think about it. It's up 2% as I look at it. And PayPal is only up 4%. And these stocks were down 80-some% at their lows from their all-time highs. And I feel like, fintech, at least in the public markets, has not been given a pass yet, especially out of the gate. You could throw a dart at how many tech stocks that were down 80% that are up 30, 40, 50% or so. And it seems like some of that is waning a little bit, which leads me to believe the concentration, and you said it, in these massive mega cap names is really the whole market here, because there is some bifurcation, going on, at least in technology right now. And if fintech and some of these darlings of fintech, and I don't even want to get into the buy now, pay later, if those things are down and out, I really feel like we could be on the precipice of like a broader move lower, especially if rates stay higher for longer.
Absolutely. And I guess the key question too, the broader one is fintech has kind of been commoditized. Big banks have learned how to do this stuff, or they've acquired companies that allow them to. They become a lot more consumer friendly because fintech forced them to do so, which is a great thing. But then you take a look at Apple, doesn't even need a banking intermediary. It just needs its own balance sheet.
2 billion installed base of devices, and you think to yourself, what couldn't they do with that, right?
4.15 APY for a savings account. And then when you think of it's just the perfect ecosystem that they've created. And, you use your Apple Card, your cash back goes into your Apple savings account, starts earning 4.15 when JP Morgan Chase, guess what they're paying you? I think it's still 0.01% on your savings.
Yeah, well, this is when I get shilly for our very fine sponsor, Current. I mean, my kids use the Current card, and they have a 4% savings account that they do have cash in there. One of them actually owns Bitcoin and ETH on it, and it's a really easy to use interface. So, like, I think it's interesting. Your point is a great one. Is that these fintech innovations have forced big incumbents, whether they be banks or big technology platforms, to kind of see the light of some of these sorts of products in a way. So that all makes sense to me. I actually really am very interested to hear what PayPal and Square have to say, how investors react to their guidance, that sort of thing, because they really have underperformed.
Going back to Square, though, also, I mean, they have another problem, and that is the Hindenburg report that there was no smoking gun, really, but it brought to light a lot of the practices. And you realize, I'd always wondered, because I covered these companies for a long time, how come Square Cash was able to monetize, P2P so much better than Venmo that has the scale that was there way ahead of time? Yeah. So Square's earnings call will be interesting because I wonder how much or how little they're going to get questions about that Hindenburg report that said they were, basically marketing to criminals.
Yeah, I feel like there's probably some problems lurking in fintech names as we get into their earnings reports. And a lot of it has to do with the fact that expectations were really low for a lot of the money center banks. And they actually, for the most part, really overperformed. And when you think about, to your point about where deposits moved to, and they did move even within some of these larger institutions to higher yielding sorts of accounts, we might have seen great deposit flight of anybody who had balances at some of these fintech companies too. So that'll be an interesting thing. All right, Deirdre Bosa was in the house today. I hope she can get back to New York City more frequently. Really appreciate you being here.
Thank you, Dan. Always happy.
Stick around. I have Gene Munster. He is the general partner of Deepwater Asset Management. We're going to go through all the major tech earnings as a bit of a preview here. So stick around and enjoy that. I am here with Gene Munster. He is the managing partner at Deepwater Asset Management, longtime fast money friend. I'm going to just call you regular contributor because you keep coming on and doing these quarterly previews of the big tech earnings. Gene, welcome back to OK Computer.
Great to be back, Dan.
All right, listen, we've gotten into a groove here, I think. We've been doing this kind of pre-earnings preview of the big ones here. And, we're recording this. It's Monday afternoon. It is April 24th. And over the course of this next week, we're going to have $5 trillion in market cap in your coverage. Not only your coverage, I mean, I think a lot of our listeners know that you were a sell-side analyst for many, many years covering the biggest names in tech. You've overseen some of the biggest, I guess, platform shifts, if you will. You've stayed very consistent on some of the big ones. But now, as also an investor, you get to be a bit more nuanced. You can kind of change your tune, I think, kind of, like inner thematic sort of stuff. Does that make a little sense? Like, give our listener a little bit of a sense of how coming onto the other side, still, covering these stocks the way you did on the sell side, but now investing in these companies and changing some of your investment time horizons. How has that changed the way you think about them from a coverage standpoint?
Well, I think the biggest difference is that you're mark to market every day. And some of our products, we have both public and private products. And having the discipline not to be focused on that, not looking at the ticker, not looking at the price throughout the day. I think that has been kind of a difference between what we do. We were, as sell-side analysts, I'm still with the same team that I've been with for 20 plus years, but we were always focused on the long term. When we believed in companies and they would pull back, we'd publish a note about the long term. And I think that philosophy, that research DNA is unchanged. I think the hardest part just has been the mark to the the minute with the trading. We do have the advantage of about 30% of our assets under management are in private, so we don't have to think as much about that. But that discipline piece is something that I would hear a lot about as an analyst when I would talk to the buy side, but did not appreciate how hard that is until you actually are pulling the trigger.
Well, the funny thing is, and obviously investors, when you were on the sell side, they probably got most emotional in and around quarters, right? In and around expectations, in and around just, where the sell side was, where the buy side whispers were, what the companies put up, what they had kind of guided to, the credibility, all those sorts of things, right? And, you hear this time and time again, take emotion out of investing, but investing is very emotional. You know why? Because to become convicted as an individual on any one theme, and then when you put money towards it, and then if you're putting not just your money to it but investors' money to it, like, it is emotional, right? And so I'm just curious, like, how do you think about that a little bit? Because you made a great point. As a long-term analyst, you can put a price target out, you can put estimates out, you can continue to tweak them, but you don't have to be emotional. And every few years, I'm sure you have, a company that just basically out of nowhere just does something, an about face on something that you thought, and you probably got emotional here and there. But talk to me a little bit about emotion and really what that means, investing versus like sell side coverage.
It's just a whole different discipline. And, I've never been in the military, but I think in the military, they kind of train you to be comfortable with being uncomfortable, that concept. And what that ultimately means is to have conviction in where you see the world is going. But there's this other piece to it, of course, which is it becomes personal when you have a conviction about where things are going. It can become personal that you have put a stake in the ground, and having the discipline to say I was wrong and to back up. I'll give you an example of a company that we had owned where I was wrong on it. It was Coinbase, and we sold it at a loss. We sold it before it bottomed, well before it bottomed, but it definitely was not the outcome that we wanted. And I was just a big believer that Coinbase had an opportunity to be the metaverse of the bank, and the bank of the metaverse. And so that was an example where I needed to just really step back and be comfortable with saying that I got this one wrong, and make the right call and sell the position.
But it's interesting, and that's about time horizon. I remember you saying that on Fast Money, and I actually thought it was a really interesting idea. And for all intents and purposes, here's a company, I'm sure you got to know them pretty well. I mean, they were really trying to operate within what they thought was the framework of the regulatory environment here, but that never really materialized particularly well, right? And so I'm looking at the stock right now, my FactSet machine, I see it down 7%. I see a couple of headlines, talking about competition as they try to grow internationally, where some of that regulatory framework is better defined. And you've already had first movers in other demographics or other geographies, the way that they were a first mover here, and they're now at a disadvantage. I also saw that Chamath Palihapitiya on his All In podcast made a comment on Friday, I think, about how Bitcoin is dead in the US. And here's somebody who's been a long time believer in it and a long time investor. And so I do think that's, listen, the other thing is you reserve the right to change your mind, and I think one of the things that you and I, who are, we do podcasts, you do a lot of TV, I do a lot of TV, you're talking a lot. People don't like to hear people change their mind too much. And you forget, I know that you probably learned this a long time ago, is that people hear what they want to hear. They cherry pick what they want to cherry pick. And, you have to be cognizant of that. But at the end of the day, you stick to your guns and things. And every once in a while, you're going to get things wrong. You admit it, you move on. So, to me, I don't think the Coinbase story is done here either. It'll probably reach a time where, just like, 6 months ago, it was, probably overshot to the downside, and it had a massive rally. And here it is, it's coming back in. So maybe that story changed a little bit. But all right, Gene, we got about 42% of the NDX, the NASDAQ 100, reporting in the next week. We have 20% or so the S&P 500. What's interesting about these names, they're also large contributors, obviously, to S&P and NASDAQ earnings, which to me makes it really interesting as we're trying to figure out what is the proper multiple on the broader market, as we also try to figure out that on individual names. Let's just talk about the first two that get out of the gate here. And these things, they seem to be really attached at the hip in 2023. That would be Microsoft and Google a little bit, for some of the themes that I think are going to dictate their earnings probably for the next, few years, if not much longer. But maybe we don't see a huge impact in some of the kind of the stories that have been affecting the stock prices this year as we relate to, these large language models and how they're going to change the search dynamic, and how they're going to be integrated into their productivity tools and the like here. I don't see too many analysts modeling too much right now for that. So the here and now really is about cloud, right? And the deceleration that we're going to see. Let's talk about Microsoft. It's up about 17% in the year, $2 trillion market cap. One of the things that's interesting, you keep hearing this notion that some of these large companies, especially in March when we had all that banking turmoil in the regional banking sector, were clearly a beneficiary as investors were looking for stable cash flows, really big moats as it relates to the monopolies of their business, the managements, the balance sheets, and the like here. And, this one got to about 30 times this year, 26 times next, kind of expensive for Microsoft. So talk to me how you're thinking about the setup into the quarter. The implied move in the options market is about 4.5%. You do that on a $2 trillion market cap, not small potatoes here.
Mm-hmm. So my sense is I'll take the down 4.5% over the up 4.5%. In part because I think just the theme around AI, it's hard to underhype it just for the long term. There's obviously been a lot of energy has been put behind investors in Microsoft and NVIDIA more recently. And I look at what you mentioned, the performance of Microsoft year to date, and Google is much lower. I think it's up like 8 or 9%, 10% this year, below what Microsoft has, how that's appreciated in anticipation of this AI. And so the reason why I take the under is that they've gotten a lot of the benefit of the AI kind of here and now, and investors are going to want to hear probably from Microsoft more than any other big tech company, NVIDIA probably at the same par, but Microsoft about just the substance of when they're going to start to see an impact. So the AI is going to be first and foremost through that conversation. That theme is going to be important for all the companies, especially big tech. But I think Microsoft has more to show for investors about when they're going to start to see the substance. I think the integration of generative AI within their products is going to be features that we're going to all embrace and love. But I think it's going to take a long time. I think it's going to take a year plus before some of those features actually become additive. And investors need to have a little bit of dose of patience, I think, when it comes to AI and Microsoft. And so that's why I'm a little bit more cautious. And I think the core business is probably going to generally do fine. There is the kind of the dynamic around white collar, some of the workforce reductions that we've seen, and that could create some sort of a headwind to some of the user numbers too. And you talked about the deceleration in cloud too. It's going to hit all the big players, but so I think when you put this together, I've got a lot of credit for AI. They're the ones who needs to show up with the most, and I'll take the underperformance, I guess, going into their report.
Yeah, the other thing is that, some of that IDC data that we saw about PC shipments, I know Apple was the worst on 40%, but some of the other ones that Microsoft obviously sells into a great deal were down, high 20s, 30%. I'm just curious, putting your old sell side hat on a little bit, those were probably important inputs for a name like Microsoft. So you have the hype that's centered around AI. You have this flight to quality during March to large cap tech. You have, the potential for a real slowdown in PCs, and maybe also in the smartphone. That's less of an impact, obviously, on these guys, or really none here. But there's a lot of good news baked into the stock, and I think you're probably in agreement on that in general.
Agree.
Yeah. All right. Let's talk about the Google, the Alphabet that reports also tomorrow night. That would be Tuesday. By the time you're listening, it's going to drop on Tuesday morning. This one interesting because, again, it seemed to be like kind of the whipping boy for, all the hype around OpenAI. When you think about the narrative that Microsoft was trying to tell earlier this year, was the ability for them to really capture some meaningful search if they have a big head start, I guess, with the integration of OpenAI into Bing. The Bard, I think you were last on, we were talking about the Bard rollout at Google didn't go particularly well. But then when you peel back a layer of the onion, the Microsoft thing didn't go particularly well too. You remember the whole Sydney incident and everything like that. And it still seems to be, from a consumer standpoint, from a user standpoint, kind of ways off of being really useful here. One of the things that I mentioned this last week on, I think, or 2 weeks ago with Deirdre, when we were talking about Alphabet a little bit, when you think about the potential inroads that Bing could make. And I don't know if anyone really wants to place meaningful bet on Google's search business. When you think about just where gross margins have come in for Google over the last 5 or 6 years, about 10 points, Gene. Talk to me a little bit about that, because there's already been some degradation, right, into this huge moat that Google has had in search and what that meant for digital ads in general. But you seem to be a bit more constructive here, at least from a sentiment standpoint, how some investors have already positioned this year between these two names.
I'm optimistic. I'm optimistic on this print. I'm optimistic that investors are going to focus on just what the framework is, how Google is going to approach AI. They'll say a little bit on the earnings call. They're going to probably say on the earnings call, hold off until May 10th when they have their Google annual developer conference, Google I/O, and they will talk about other product integrations within AI. With Microsoft, we've thought a lot about Office and thought a lot about how it can impact Azure with AI. In the terms of Google, they've got 9 platforms that are more than 1 billion monthly active users. That's a big number. No other company even comes close to that. And so they've got engagement, and you can, at different layers, different levels, layer these AI products into those massive bases of usage. And I think that has been the surprise to me on Google, is that the light has not gone on for investors. And the reason is that what you just described about what's happened with margins over the past couple of years, and this belief that, yes, AI is going to be transformative, but it's going to be at the cost of Google search. And the idea of course, instead of going to 10 blue links to just get the answer, you don't really have an advertising business if you just have one result. So my view is that our margins are going to go up or down. I think probably near term, I'd say next 1 to 2 years, they are probably stable. And the reason why I don't think they're going to go down, even though there's going to be this transfer in terms of how people do advertising, is that they're being more, they refer to a durable business model, of course, and that's AKA for more headcount reductions. And I think that they'll be able to kind of offset some of the investments that they're making into AI enabling these products with being more judicious in terms of how they're spending money. So I'm actually okay. I think margins ultimately go back to where they are. And I would just point this out. Was it in 2017, Google changed their message to investors. It was organize the world's information, and they shifted that to being an AI first company. And at that point, that was when we started to follow along on their earnings calls and would count the number of times that they would say AI. It was like 15 to 25 times a call. And we thought it was pretty funny. We did it for 3 or 4 years, and then we stopped doing that. But the bottom line is they've been at this for a long time. And I think Google is pretty smart. I'm not a huge fan of just mainstream media in general. Not any political statement. I just don't spend a lot of time on it. But 60 Minutes did a piece with Google a week ago, and kind of on their AI initiatives. And I think it was really telling about the depth that they have thought about this. And I would encourage people to check that out to give a better sense of how serious Google is and the progress that they've already made.
Yeah. So one question on Google here, if you think about Alphabet in general, we know that, where they get the bulk of their revenue and earnings, right? And we know that they've been playing around the edges on these other things. And I think to your point, I mean, their investment in AI over the last 5 or 6 years is probably something that has yet to be recognized in the value of the stock here. When I look at their net cash balance relative to debt, relative to their market cap, okay, at 1.35 or something like that, they have like 85 billion in net cash. And when you look at versus, let's say, Apple, which is a $2.6 trillion market cap, and it's got about 50 in net cash, or Microsoft that's got 20 or so in net cash on a $2 trillion market cap or something, does that put Alphabet in an interesting position to maybe do something around the edges, and maybe an environment that is more conducive to M&A, but also, like, when you think about what Microsoft just invested in OpenAI, maybe there's some sort of partnerships out there. Does that mean anything to you, that kind of net cash position relative to their peers and relative to the market cap?
It's part of the surprise about why I think I'm surprised that Google hasn't acted better. And there's one piece to it, which is sleep well at night. Investors can sleep well at night knowing that you have a lot of cash. And there's the other piece to it, which is what can they do in terms of how to really capitalize on what's going to happen in the next decade, because it is going to be jarring. And I think that will they do something? I suspect that they will. They have been acquisitive in the past. Of course, their best acquisition, YouTube. And ultimately, I think that, who is that partner today? There's still so much sorting out that is going on when it comes to the tools that are enabling this. And I think that they're in a good position where they can pay up for something like that. I suspect that they'll be making investments kind of across the board, and potentially public companies and private companies. We're just going to hear a lot more about that cash piece. I'm glad you flagged it, because it's something that I think is underappreciated about the Google investment case.
Yeah. All right. Let's look at Meta here. This is one that has been less controversial in 2023, up nearly 80% on the year, up a lot more off of its lows from last year. And this is one of those ones, man. I mean, I'm sure you were left scratching your head in late 2021, that huge shift towards metaverse. And it wasn't like what you mentioned about Sundar and Alphabet back in 2015 declaring that they're an AI first company and then doing a lot of stuff. They just came out and said, we are a metaverse first company. We're changing our name. And no one knew what the hell it meant. And no one knew what they were going to do. You know what I mean? And it was really one of those things where when their core business really started to show some cracks in a weakening economy, better competition, the list goes on and on and on, right? TikTok, I'm sure, had something to do with all of that. The thing just fell out of bed. And you and I have to go back to the year 2000 to remember a much loved stock like that, you know what I mean, both in retail and institutional, dropped the way it did. I think at its lows, it was down nearly 80% or something like that. So the fact that it's come back here, you start looking at this thing, and I know that a lot of folks are looking at it from a valuation standpoint. It just looks really attractive, even after the stock has rallied here. So talk to me a little bit about what you're thinking about in this name. And, you get this question all the time on CNBC, I'm sure. Is it too late to get into Meta or this and that, or whatever? I'm just, what are your thoughts here? Because they don't seem to be talking a whole heck of a lot about metaverse. It's really been a lot about cost cutting. And we know that, again, the spend on metaverse and all the hiring that they did during the pandemic, it seems like Zuckerberg is very focused on doing that. Have they done the bulk of it so far?
They have done the bulk of the reductions. And I would put Meta in the camp that they probably have done the right size. They're just about 25% has been reduced. That compares to most of the other big tech companies at kind of the 5 to 10%. So they've definitely made more headcount reductions there. So I think that they've made the hard choices. And ultimately, I think it's going to be this is still one of our biggest positions, Meta. We owned it higher. It went lower. Right now, our position is in a good place. We could sell it for a gain, but we're not. We're sticking with this because we ultimately think that just their core business piece, like you said, is really exciting. We're also believers in the metaverse. And I recently wrote a piece. Everyone's talking about AI, but don't forget about the metaverse. And this is controversial, even though Meta stock has rebounded. The concept of the metaverse is still up in the air. Over the weekend, Mark Gurman, who does great work for Bloomberg on Apple, published a piece about Apple's new upcoming AR headset, their MR headset, which they're probably going to show in June for the first time. And his report was more about how Apple's struggling to find a use case around the metaverse, which speaks to, is the metaverse going to be real or is it going to be 3D TV? And I'm in the camp that eventually this is going to become something that does have substance to it. It's going to take up a lot of our time. We're going to spend time in the metaverse. And I think Meta, the company, eventually is going to benefit from it. So, well, not the reason why we own it. It's nice to have optionality value around the metaverse. And I think Zuckerberg and his change in direction and focus on profitability in the last 6 months, 3 months, has been a refreshing reminder that he's competitive and he wants to win, and he's going to get the business to be more profitable as they start to build towards that metaverse.
It's interesting that, he's a guy where he used to tussle a little bit here and there with like Elon over AI stuff and like every once in a while in the press. And I give him a lot of credit because, he got absolutely destroyed in late 21, right? With the whole metaverse, at least the rollout and the way that they did it.
Top ticket.
Yeah, no, I mean, really did, right? And he's really kind of kept his mouth shut his head down, and they're just doing the hard things that they need to do. And it makes you think that here's a guy that is going to be around in this same role at probably a much bigger company in 10 years from now. You know what I mean? Like, he's not going out on the lows or something like that. And I had somebody who worked for him for years on the pod last year say to me, and knew him in his early days and saw, worked on Instagram and a lot of their stuff in and around digital currency. And he said, listen, a lot of people, the press want to say this, that, or whatever about him, but I would not bet against this guy of being a great wartime CEO. And it seems like they've been in a war over the last couple of years, and let's see how it comes out. So that's a good rundown. Here's another guy, and it's funny. All of these companies, well, not all of them, but Amazon's another one where pretty critical time where they don't have the founder in place anymore, and that's why I just wanted to make the point about Meta. It's hard for me to kind of think about a Facebook Meta without Mark Zuckerberg at the helm. And I think a lot of investors, let's say in Amazon, have not really gotten used to Andy Jassy as the CEO after 25 years or so of Jeff Bezos and the reverence that people had for him as an operator. But I know a lot of people like you who spent a lot of time around this company following it from the sell side, but then as an investor also, they knew that Andy Jassy was like, definitely one of the secret sauces to the success of this company, especially when you think about, what he did with AWS at a time when it was always controversial, AWS from the get-go, right? And so then it became this engine to fund all of these other operations. Talk to me a little bit how you're thinking about Amazon in the print. Stock's up 26% on the year. Listen, people are not really comfortable about valuation right here. They never have been. And I think that that's probably not something that we probably want to focus on at this point. It really is what they have to say about AWS cost cuts. We know that they're cutting back on a lot of the kind of free returns and free, all that sort of stuff. So if you're an Amazon customer, you see the focus on this because you keep getting updates about stuff that they used to be very happy for you to be a beneficiary of as a customer, less so now.
Exactly. And I think my general sense, and this is probably more consensus. I don't like to be in consensus, but in this case, I'm in the camp that I think Amazon's going to have a tough few quarters here. And you talked about they're making some of the changes around the cost structure. I think there needs to be a substantial amount more of cost reduction out of the system. And then there's, of course, the macro. I'm awful of the belief that the next couple quarters, I think the macro is going to continue to pressure some consumer spending, and Amazon obviously plays a role in that. And the piece I struggle with Amazon is that's all pretty obvious. Like it's they're cutting and they're going to be impacted by a weak consumer. I think most investors know that, so I don't know how much is priced in. Typically, it's never always. Typically, it's rare that things are fully priced in. But so I think this is going to be a tough year for Amazon, and I think that as you kind of fast forward into 24 and 25, I think the setup gets much better. And so our general sense is like just going into this print, I'd say I'm more cautious than positive.
Yeah, no, and it's one where again and again we say this. It's like their North American retail business is basically valued at zero. And so here's the thing: if we see this material deceleration, like in AWS, like happen, and we're seeing this across the cloud space in general. If you start modeling that out a bit further, if we haven't even seen the recession yet, right? And then you talk about consumer behavior on a bunch of their other stuff, you say to yourself, okay, I mean, like this is probably a pretty expensive stock exposed to some of the like really at the going to be the center of the storm as it relates to a US recession if that happens. And so you have to have a probably overly optimistic view about the fact of whether we're going to have this slowdown that everyone's predicting or not, to really feel comfortable about it. I just kind of think about things sometimes relative to their recent highs or their 52-week highs or their all-time highs, which we've seen in most mega cap tech stocks in the last year and a half or so. This thing acts very poor relative to all these mega cap names that we've talked about. So it seems like that is definitely a concern of many investors. And again, the rate environment doesn't make it easier investing in a stock like this. Is that something that you've been thinking about a lot? If we were, we're at this, nearly 5% down in Fed funds, is that really play into your investment thesis as you think about valuations in some of these big names, Gene?
Absolutely. I mean, you got to be more valuation sensitive in this. I think that's one piece that's distinguished us from other frontier tech investors is that we care about valuation. And in the case of Amazon, we're just not comfortable with that valuation relative to the dynamic. I think you framed it in perfect. I would just add one finer point is that the AWS call, it's gone from 30, 40, 50% down to basically 10% in the most recent quarter. It's dropped. Most analysts think that we're going to see a reacceleration, kind of that high teens, low 20s next year. And I think we probably won't see that level of acceleration. So we still need to right size some of the numbers around their key segments, I think, before the stock can really start to build higher.
Yeah, and when you also think about, and we've talked about this, I mean, their advertising business has become very big, and that's obviously going to be weighed on not just because of some of the ad trends, but if they're having lower retail sales and the like here, I mean, that's something that could continue to weigh. So yeah, I'm keeping a close eye on that one. That one probably seems like the most interesting to me, the potential for the most volatility post report here. All right, let's do this one. The big kahuna next week, Apple. And I got to say this, I always give you props because, back in the day, used to come on, Fast Money, and we'd be talking about the reports, and you were just always so steady on the name. You just never, even when it was in the throes of some of these kind of 20, 30% drawdowns, which it routinely was, you know what I mean? But like, it was always one of the first tech stocks to kind of reemerge, making that new high, you know what I mean? Whatever it was. And so, it's funny because you want to pick on names of people like me who are more talking heads. I'm certainly not an analyst by any means here. This was an easy name to try to pick on because of the universal optimism in the name. You never downgraded it like that I can remember, like just giving up on the name. You know what I mean? Where often analysts do when they're in the midst of like, a material drawdown. When I think about this one, it's just like, yeah, look at the 2-year chart of this thing. It's been really volatile. Some would say it's a great trading stock, right? Because when the sentiment gets bad, at least from a price standpoint, here's a company that is so consistent, right? And they're going to basically do what they say they're going to do for the most part. And the only times that I've seen them misexecute has been something more geographic. It was China in 2019. You know what I mean? Like they're generally kind of there, and they're not going to get overly hyped about their AR, VR launch and this. That's not going to be built into the stock. We're not going to see some excitement around open AI or large language models. It really comes back to 55% of the revenues come from this product, which is the iPhone. They have 80% of the gross margin in the entire smartphone industry. And that's it. Their ability to kind of grow their installed base and grow services on top of that at a higher margin. That's the story, right, Gene?
It is, and it's. I would put that as just stability as part of the story. Investors, the sleep well at night component. Apple obviously has that. I would also kind of put the different pages, the different or chapters. I think of the Apple investment story. Chapter 1 was really about devices and the iPhone and a little bit of the iPad. I was really focused on that. Chapter 2 was, of course, services. This is kind of 2015 to 2020, 21. Is just investors starting to recognize the reoccurring piece of that business. And I think we're now into the next chapter. It's not as glamorous, but I think it's something that will bode well for the stock. And that's this consumer staples chapter. And, this concept, that's not a new concept. It's been out there for a couple of years. Just the idea of this is Coke and Clorox. And those stocks, surprisingly, Coke and Clorox trade at multiples just below where Apple's at. And they don't have, I think, some of the optionality value that Apple has. But, when each of these big chapters starts, it usually takes a couple. Let me make sure I didn't lose you. Did I lose you here, Dan? Okay. Computer went on, went to sleep screen. But each time there's a new chapter, it feels like it's over. Like when you're talking 1-2 years in it, but these are 5, 7, 10-year types of movements for investors. And so I think what's important here is we're entering a new phase of how investors think about Apple as a consumer staple company. And we saw it last quarter. Apple doesn't miss their numbers very often. They missed it in the December quarter. They told people, this is the crazy part, in November, they put a press release out in November and said, we're going to miss our numbers. They didn't say about how much. It says because shut down in China production around the iPhone. And then they missed the miss. Basically, the stock kind of went down in anticipation of that and then just kept kind of going up. That was the third time in 10 years I'd seen a miss from Apple. And I think the response to the stock, to me, is evidence that there has been this shift in how investors are thinking about this. It's not about what the iPhone number is in the quarter. It was down 8% in the March quarter. It's not about what it's going to be in the June quarter. It's about we are dependent on these devices. And when it comes to dependence on devices, no other company, Samsung, Google, they also have products that tie hardware and software together, but nobody does it like Apple. And as our worlds get more complex, whether it's through the devices we have today or maybe some form of wearables in the future, Apple's probably going to be the premier company to keep bringing all this together. And that is a recipe for consumers needing the products and higher multiples because of stability in their business. And so I'm optimistic, and I think they've got a couple of shots for really kind of breaking out. I don't think mixed reality is going to go anywhere anytime soon, but I do think that if they do something in automotive, that could really shake things up.
Yeah, and I mean, let's be fair, that's years away if you think about it, unless there is like some super secret project, Titan X or whatever, that really is an operating system that they can monetize from a services standpoint. I mean, no one wants to see them in the business, I don't think, of building cars, you know what I mean? Like, but I look at this stock and I say, for all the reasons you just mentioned, I get all of it. It's great. But in the last year, there have been 30% moves in a stock that has a $2.6 trillion market cap. And so what I'd say for folks like who buy everything that you just said about it, I don't think there's any reason down 10% from its all-time highs made the first week of 2022 that you have to go buy it after a 30% rally. And I'm not saying that that's what you're saying by any means, but like my point also about those 30% declines that we've seen peak to trough over the last 5-7 years, they happen. Dollar cost average. If this is your favorite name and you want to be there, the one thing I'll just say, and this is something, and to your point about missing earnings, let's say 3 times the last 10 years, one thing that could add a lot of volatility into that earnings, and certainly the dollar round tripping is going to help out a lot as you consider how much of their sales come from overseas. But the situation with China is not one that I think, should be poo-pooed here. When you think about their reliance on manufacturing in China, the cozy relationship that the company has with President Xi, when you think about how developed their supply chains are in and around China. So Taiwan, this could be a real huge hot button issue. And the precedent that was set, and you and I've talked about this, the precedent that was set by US multinationals pulling out of Russia when Russia invaded Ukraine last year, this could be an absolute mess. Now, I know that Tim Cook is quietly, he was just in India. They've been in Vietnam. I mean, these are all going to be big things. But here's the one thing that I don't think US investors are paying enough attention to. At some point, the Chinese are going to see all of these actions together, okay, and the ban of advanced technologies, sold into China, and they're going to say, we're not going to be in it for all of these sweetheart deals that we have given you. You know what I mean? And then when the consumers turn from a nationalistic standpoint, and that will happen, this could be an absolute disaster for companies who are relying both on manufacturing, supply chains, and also consumer demand. Thoughts on that point, because I'm not telling you can put your finger on that this year in 2023, but I feel like that's something that could be a massive headwind.
It's gonna, that will rise above the surface, and it will be a topic. It probably at some point in the next 2 or 3 years will be one of those 30% downdrafts in Apple. I think that absolutely could happen. And I would just put one other piece to that equation is when you grow up in China, you learn that Taiwan is part of China. It's pretty straightforward. And I think that so there's a political point about China doing something with Taiwan that obviously has an impact with Apple. But there's also a more of a business standpoint in running their country. Is right now some of the trade restrictions are making it difficult for China to get a hold of advanced chips. And Chinese, they do a lot of things great. They don't do chips particularly well. And I think that there is, if you're going to ask me to paint the catalyst, I think for something happening on Taiwan, I think it's related to essentially some of that supply of these advanced chips that you need for AI, you need for military, you need for consumer products. All those are getting, China's getting choked off from right now. And you could say, you could build a case where Secretary Xi says that he's going to make a move on Taiwan for that. So low probability because it would be such a big event, but there is a very logical case of how that could happen. And Apple would be probably one of the first companies to get hit by that.
Yeah, no doubt. Okay, last one here before we let you go. And I really appreciate all of this analysis heading into what I think is a really pivotal week for the markets, especially when you consider the Nasdaq is up, nearly 20% from its lows made late last year, early this year. The S&P is up nearly 20%. Also, when you think about these companies and what they have to say, I'm more focused on what they have to say about the environment right now and what they're willing to do as it relates to this current quarter guidance and how much visibility they have deeper in the year. So that's why I think all these names are really important. Really quickly on Tesla, I know this is one that you followed. I know that our listeners, you don't want to hear another word from me about this, and I'm not going to say anything more about this, but give me your quick thoughts on it and how it made you think about positioning near term versus, let's say, some of the longer term themes that I know that you're very bullish about. And then the last one, it just seems like, Elon and crew were really focused on the macro and really wanted to blame a lot on the macro environment and rates and the like. So I'm just curious how much you bought that and what you're thinking right now here, because just in a nutshell, I think the fundamentals have shifted pretty dramatically over the last couple of quarters. And if the macro gets worse from here, this stock gets much worse from here, in my opinion. And then it's layer in all the stuff that we just said about China with Apple. I think that they're probably next in line as one of the most important companies there. So just thoughts on the quarter, thoughts on what they had to say, and maybe how much emphasis you are also placing on the macro as it relates to Tesla.
So as far as the macro and what's the true impact been, we can look at what the growth rate of Tesla has been in with deliveries relative to the top 6 automakers. And over the past 3 years, it's been about a 4 to 5. Tesla has grown their deliveries about 4 to 5x faster than the rest of the overall auto industry. And as numbers get bigger, it's harder to make that growth, but that's been the number, 4 to 5. And in the most recent March quarter, it was a 3.7x to be specific, a drop kind of below. So that has drifted down. If it was just the macro, if it was entirely the macro, then the rest of the auto industry would have come down and we'd have still seen that 4 to 5x gap difference. And so to answer your question, is the macro is having an impact, but also there is a law of large numbers. And that's a problem when you have a growth company like Tesla. Law of large numbers does not sit well with growth investors. And so that is, gets us to the point where the stock is today. And this is such an emotional stock. Like, we talked about a 30% downdraft and updraft. Of course, with Tesla can be much bigger moves. And so I do not want to put a stake in the ground on where the bottom is in Tesla. I do say, I was talking about earlier about some of the traps that you can fall into as an investor. And one of them is when you have a belief and testing that belief, and then maybe being blind to changing your opinion, making sure that you are asking or being open to change your opinion. And I think a blind spot that I have is a belief that traditional auto is in trouble and that they're going to have a difficult time turning the corner to electrification. There's a lot of reasons behind that, but that's kind of the bottom line. And because of that, I give Tesla more room to, kind of inflict more damage on traditional auto through this period. And I think that ultimately they're going to come out in a good spot. And so I'm still optimistic. I think there's comical things that Tesla says. Elon's comment about FSD this year, I don't know why he said he still thinks that. That's what he said last week. It's like almost borderline irresponsible for investors to hear that. He says it because he's trying to prove a point that they can make more money selling FSD longer term and that it's around the corner. But it would be nice if he would just say we're 3 years away for FSD versus every year saying he's going to be late. But
you know what? But Gene, he can't say that. If he does that, the stock goes straight to $100. I mean, like I'm just telling you, like that's been. And that's the point about, the whole story. And, they got to talk up the Cybertruck. The Cybertruck's going to be a disaster. It's going to be DeLorean all over again. I'm just telling you. So all right. And I said I wasn't going to say anything, but that's the thing. And I think that's what's coming unwound. And, and if there is a new CEO of this company by the end of this year, which it might be, okay, I'm just telling you, and they're going to have to reset all of these expectations because no one's going to take over this company and they're going to haul his lies around for the last, few years about these products. And you can say, well, lies may be a little aggressive, but they are because none of them come true. And so if you keep reiterating stuff that, in emphatic sort of manner and it doesn't happen, to me, those are mistruths. And so, he's subject to everything else that all of these publicly traded company CEOs are. But for some reason, he's been given a pass until very recently.
I do have one question is you talk about the Cybertruck. I'm be curious. We don't know. There's rumors of what the reservation list is. It's just that rumors, not even worth quoting what the numbers are out there. But I'm just curious what your belief it's going to be DeLorean 2.0.
No, my point is it's not a car that has like the potential. If you look at their high end cars, and you've been saying this for a long, they're not selling anymore. Like the Model S, okay, like they're not selling anymore because they haven't refreshed them, and they have all of this competition. And you and I've talked about this from the Germans, from the Japanese. Even some of the stuff that's made here are much better. I just don't. No one's going to buy that car. I'm just telling you. Matter of fact, you will not. You will see a bunch of his fanboys. They will end up losing more money in Tesla stock. You know what I mean? That it costs to buy the car, and it's just not going to make any sense anymore. Like it's not something. When is the last time you've seen somebody introduce such a radical design that you expect to have some sort of adoption at such a high price point? You know what I mean? Like it's like you got to go to the Paris and the Milan like fashion shows to see, you know what I mean, that sort of behavior, and those things you don't see in the wild. And I know that sounds very simplistic, but I just don't see people driving that car.
So just one, if we can go over time here, one is when the vehicle first came out, I thought they just released a dud. The night that it came out, I actually put a reservation in because when he broke the window, I thought that was funny, so I put a reservation. I actually do have a reservation, and the note that I wrote that night I don't know if it was the headline, but the substance of it is, no construction person is going to want to show up at a job site with this truck. And then about a month later, we went with a bunch of Chipotle cards, $20 gift cards, and we went to a big construction site down by our office. There's hundreds of construction workers. They're building like a 400-unit apartment building. And we sat there at lunch and handed out, and we asked a question about Cybertruck. We were aware of the Cybertruck, and we published the findings on it. But loosely, it was 3/4 of people who are under 35. And the price point's probably going to be what a decent F-150 is going to be, you'll probably be 55,000, something like that. But what surprised me is how many people said, again, sample of small, whatever it was, the 20 people we talked to. But I would say this: talk to the person who's doing. Next time you're with somebody who has a pickup truck or some sort of a handy person who's out doing plumbing, or somebody. There's a lot of pickup trucks. It's almost 20% of the vehicles. Ask them what they think about the Cybertruck. I was surprised. That's dated. That was a few years ago. I need to update that survey, but that surprised me.
Yeah, I mean, these are not people generally, and who subscribe to some of the beliefs of those who want to electrify, the grid or the auto business and this and that or whatever. And so, look at the market share that we saw the drop last year in Q4. You've seen some of the numbers in California alone, right? This is probably an audience that's probably okay with some of the reasons why Elon has made such a big impact on the move towards, electrifying, the automobiles in general. I just don't think that demographic is going to be particularly that interested in electric vehicles. And I don't think they're going to be that interested in a truck that looks that way when a lot of their bros are pulling up with their Rams or their F-150s or this and that, whatever. Purely anecdotal. But I'll just say this. I just did a Google search for Cybertruck pre-orders, and I go back to supposedly in August of 2021 they had 1.25 million, and then I go to November of 2022 and they have 1.5 million. That doesn't seem like a year and a quarter away as a huge number. And then I mean, like, to me, it's a big fugazi. Like, so and then in January of 2023, just put pre-orders for Cybertruck, and this is all coming up, whether it's true or not. So they're still at 1.5 million. I just don't think it's a real number.
Well, I don't know if the 1.5 is real. Those are the similar numbers that I've seen in the past. I would Ford sells. They sold 650,000 Lightnings last year, best-selling vehicle in the U.S. So it's a big number. 1.5. I don't believe it. It's a lower number, but even if it was 500,000, I think it would be a formidable number. And my question is, appreciate what you're saying. Like, I don't see a lot of these people, going and charging up their trucks at night. But I was just surprised at some of that early commentary. My concern with the Cybertruck is not on the demand side. It's just making sure that they deliver something that works. And, they said they're in production right now, but, you pick up data points, how solid is it right now? And is it fully functioning? And they still got work to do. It's not shipping now. They said it'll be out in the September quarter. I think at a minimum, Tesla stock probably gets a bump in hype when it comes out, and then probably they'll disappoint for the first few quarters. And then the nice thing about this, I think this topic's going to be a gift that keeps giving between Dan, you and I, because let's just keep it going. It'll be a fun one for us to debate.
Let's do it. I totally, not only do I love debating with you, I get smarter every time I talk to you. We really appreciate your preview of these major names, and I can't wait to see you next week or this week on Fast Money, real time with that red phone. So thanks so much. Gene Munster, he is the general partner at Deepwater Asset Management. Thanks for joining us again, Gene.
Thank you, Dan.